This is not the year to be scamming on your taxes. The IRS has hired 80,000 new agents to make sure Americans pay their fair share of taxes. And we want to make sure that we are paying what we need to pay, but not $1 more than that. So let's go over some tax tips for filing your 2022 taxes, okay? We're gonna cover some key dates. I'll give you the standard deduction, all the basic numbers that you need to know, plus some credits and deductions that you could be eligible for. And what's most important is how to avoid paying taxes, right? There's ways you can reduce your taxable income, and we're gonna go over that towards the end. So keep it out for all that and more. It's Crystal with the Cash Compass. All right, first things first. This is due April 18th of 2023. If you file your taxes after the fact, you might find yourself with a fine, okay? You might find a fine. All right, step into the side so you can see your tax bracket, all right? Your money is taxed in increments. So if you are making, let's say, $171,000, right? You'll fall into the 32% tax bracket, but not all your money is getting taxed at that amount, okay? It's graduated amount. So you're gonna have 10% on some income, 12%, and so on and so forth, but not $1 should be taxed anymore above 32%. That's how you read that, okay? Standard deduction, this is really important. So whatever you've made, let's say you made $100,000 this year, if you're the head of household, you're gonna get $19,400 removed from that $100,000, right? So they are not going to tax $19,400 if you happen to be a head of household. Now, most of the credits and deductions that we talk about are based off of your AGI, which is your adjusted gross income. The most conservative way to see if you're eligible for a credit, just go by your base income. If you don't want to do all the math, your AGI should never be more than what you actually make. If you want to get that exact adjusted gross income, these are the items that are actually deductible for the most part, and there might be some more. Let's say you may or may not be eligible for one of these credits, right? Like, let's say the limit is $100,000, but you make $105,000. Well, if you're kind of close to the threshold, then you would probably want to get your AGI and just see if you have anything that's eligible within this list to bring that income down. Now, something that people are super relieved about is that $600 new tax law that came out about last year, it's over with, all right? They are not going to actually make that a requirement for this year in 2022. But for 2023, it is still applicable. So we have a whole year to get it right, y'all. If you need more information on that, I have a whole dedicated video that you can watch right now or after this video on that new law and what you need to do if you're getting paid from Uber, Etsy, eBay, Airbnb, like literally any of these apps that kind of connect you with customers, you're going to have to get reported on in 2023, okay? So 2024, it'll be a problem. You can come back to my channel for an update on that. All right, credits versus deductions. In a perfect world, we want it all. However, if you had to pick one, you want credits. Credits is a dollar for dollar attack at that tax bill. What the credits are basically saying is, we've calculated what your tax bill is, here's the amount, and then we're gonna have some credits that dollar for dollar reduce the amount that you owe or increase your refund. A deduction just reduces the amount of taxable income you have. Instead of saying you make $100,000, maybe the deduction will take off $10,000 off of your taxable income. So even though you made $100,000, now you made $90,000 because that deduction deducted from your income. Don't expect a lot more money this tax year because during the pandemic, they was giving out credits left to right, all right? And that only was a one-year thing, a one-time thing, if you will. So for this year, things like the child tax credit was slashed, by thousands of dollars, all right? So it's gonna be a bit of a shock, but don't say I never told you nothing. Now, when you're actually preparing your taxes, you're going to do deductions first. Let's talk about deductions. In most cases, the average American will probably get by pretty well with that standard deduction, especially if you're somebody who doesn't really have a lot of moving parts in your life. Maybe you don't have a lot of medical bills, or you don't have a lot of investment stuff going on. Chances are, if you itemize, it might end up being a whole bunch of more work and you might not even reap the benefits of it, okay? So here's a list of what people typically would itemize. If you have any of these expenses, but they do not exceed the standard deduction, go with the standard deduction, okay? Because with itemized deductions, it's a lot of percentages of this and percentages of that. Like, you can't just say, oh, my medical bill is $10,000. No, they want you to do math, calculus, algebra, just to figure out what you can actually deduct, all right? There are some deductions that you can still take advantage of with the standard deduction. The first one being HSA contribution. This can help you reduce your taxable income by about $3,600 if you're under 55, okay? And this is a health savings account. So you're actually taking care of yourself and lowering your taxes. We love a 2-for-1. Traditional IRA contributions are also really nice because you can do this not only during the year, but also after the tax year. So if you're watching this right now and you haven't filed your taxes yet, you can put some money into your IRA, your traditional IRA, and that's actually going to reduce the amount of taxable income you have. For my procrastinators, it was thinking about you. Home office deduction, okay? This is not for people who work from home, unfortunately, but for people who have a business. Remember, Uber is a business. Instacart is a business. These things are businesses as well, okay? So if you're doing any side hustle, I'm talking directly to you. If you have a dedicated, okay, that's the key word, a dedicated space in your home that you use for these things. Uber, for example, let's say every week you come together and you come on your computer and you figure out how much money you've earned, how much money you paid in gas. Like if you're sitting in a dedicated space, that is your home office and you can get a deduction. And this deduction will cover all the home expenses, all right? So you're thinking your utilities, your rent, your internet bill, right? So all of these things that you are using in your home, your personal expense, you can actually extract a bit of that out as a home deduction. So there's two ways to actually get this deduction. Either you just take $5 per square foot, so you don't have to worry about calculating, the percentage that you've used of the light, the percentage that you use for the internet, right? They're taking a clean $5 per square foot, right? Up to $1,500. But if you're somebody who has maybe a little bit of a larger office relative to your home and you have really high expenses, it might make sense for you to actually just get the right dollar amount. So I would say if you're doing the home deduction, it doesn't really hurt to do both methods, right? Let's say you have an 1,000 square foot home, right? And your office is 250 square feet. Well, that represents 25% of your house. So you could take 25% of your light bill, of your internet, of your whatever other bills go into your home, right? And you can deduct that way. So you're doing it the longer way, but if you think it'll be more than $1,500, that might be a better option for you. All right, now we got some credits, all right? So the child tax credit, that was one that got a big hit this year. So you're not gonna see as much benefit from this, but it's still pretty good. Up to $6,000 of expenses can be deducted, all right? So if you have a kid that you're putting in some sort of childcare, daycare, something like that, you can get some money back from that, right? So the max you can get back as a credit is $2,100 if you have 2 kids, all right? If you have 1 kid, it's only $3,000 worth of expenses and a percentage of that. The earned income tax credit is always a pretty popular one. If you're eligible for the earned income tax credit, I highly suggest you do it sooner rather than later because those are always delayed. They're going to be heavily scrutinized, so you want to make sure that you are actually eligible because the IRS is coming this year, y'all, all right? Here are the qualifications as far as your age and how many kids you have and what you can actually get back, all right? So just taking a look here, if you have no kids, you can still get this money back, all right? $560 would be the max you can get, but you cannot make more than $16,000. 3 or more kids, right? You make it bank, right? You're gonna get down almost $7,000 of a credit back, but you cannot make more than $52,000, which obviously if you're making $52,000 with 3 kids, you're living tight because kids in America is extremely expensive, okay? Don't ask me how I know. The American Opportunity Tax Credit, these are for my kids, okay? The kids in college. This is a refundable tax credit. So if you're in college and you don't have anybody claiming you as a dependent, even if you don't have a job, you can receive up to $1,000 back of a tax refund, y'all, okay? That's the beauty of credits, specifically refundable credits. The American Opportunity Tax Credit is actually $2,500, right? But only $1,000 is actually refundable. But like, let's say you did have a job, you can get $2,500 back to you. If you own a home and you have a roommate, no, I'm not talking about your spouse, but anybody you've rented a room to, you are a landlord, babes. And you need that landlord credit. Here are all the expenses that you could deduct as a landlord. And there's more. It's pretty much anything that you're putting into this house. Now it's gonna be a percentage. So like, again, back to the other example. Let's say you have a 1,000 square foot home and you have somebody you're renting one of your rooms to, and that room is 250 square feet. Well, 25% of almost all your expenses in your home can be used as an expense. Now you do have to report the income as well, but you can also write down depreciation, which is taking off a piece of how much your home is worth off of your taxes. So there's really a potential to reduce your taxable income by thousands of dollars, all right, if you do this correctly. So you want to make sure you're keeping track of all the expenses that you've done to the house, how much rent you're collecting. I mean, it's even things like cutting your grass, right? That does benefit the renter as well, right? These things can be deducted as a percentage of your home. So that's some pretty good stuff, and you definitely want to get with a tax professional if you fall into this category, because again, this is like a gold mine. People love real estate because it's a tax haven. All right, how can we just avoid paying as much taxes as we possibly legally can? All right, we're all about doing legal things on this page. Consider contributing to tax advantage accounts. All right, that's typically your traditional 401k, and your traditional IRA. With the IRA, after the year ends, you can still put money in there, so it's not too late to reduce your taxable income. Number 2 is the tax credits and deductions. Just really think about everything that you're doing, right? Because there's even credits for saving your money. If you're putting money in a 401k, right, that's a tax credit as well. So you want to make sure you're talking to your tax professional so you can get the most credits that you are eligible for. And that's why it's important to listen to these videos whether or not you have somebody preparing your taxes for you, especially if you have someone preparing your taxes for you, right? Because how are you going to know if they're good if you can't even do a little test on them? Tax loss harvesting. This is something that I know people could definitely take advantage of because there was a lot of L's in the stock market, okay? So if you had some winners, you can sell some of those losers to offset those gains. And even if you, let's say you didn't really make any gains, you didn't capture any gains, right? In other words, you didn't sell your stock for a profit, it can still go against your ordinary income as well. So money you've lost in the stock market can actually reduce your taxable income. Now it's up to a certain amount, so you can't go crazy here, but this is a way to help reduce your taxes. This is a weird one, but consider getting married. When you get married and you file jointly, if there's like a mismatch in income, so let's say maybe your spouse earns more than you or they earn less than you, you'll definitely benefit from filing your taxes jointly, okay? Because all the amounts double. So that might actually mean less taxes that you have to actually pay, all right? Because there's a lot more bigger thresholds for you. Also consider maximizing your medical expenses, okay? So we talked about your health savings account earlier, your HSA, but premiums from your health insurance, dental insurance, and medical, they're all tax deductible as well, right? So like those are not gonna show up in your taxable income. So if you, again, find yourself owing the IRS money, pay yourself a little bit more, right? Get the higher plan. This is not financial advice. You have to talk to somebody in particular. I am a CPA, but I'm not your CPA, unfortunately, right? So you want to definitely double check all that I'm saying. But the option is you do the higher premium or you put some money away in your HSA just so that you're making sure that you're taking care of your medical, right? Because this body is more important than that money. Also consider starting a business, all right? Businesses are literally gold mine for tax advantage things, baby. You can deduct almost every single expense that you use in your business, right? Whereas in real life, you can't really do that, right? In real life, if I buy a pen, that's it. In business world, if I buy a pen, that's a business expense, right? Everything that I spend money on, I could think about in a business expense perspective, okay? And if you're just starting out with a new business, you can actually deduct up to $5,000 immediately from a startup business. If that's something that interests you, you'll definitely want to watch this video where I talk about all the business expenses you could take as an individual. Remember, side hustlers, that means you too. See ya.